Hi everyone. For investors, financial market turbulence, uncertainty, and volatility can be nerve-wracking. Add in the coronavirus, and the mix can be downright scary. Last week, the 10-year Treasury broke under the 1% mark for the first time ever. The rapid decline in the rate followed the 50 basis point emergency rate cut made by the Fed on Tuesday morning. Now, undoubtedly, the Fed cut the overnight rate thinking they would shore up confidence and extend the economic cycle. But the cut actually had a different effect. It caused a very swift negative market reaction. Wall Street traders may have interpreted the cut as the Federal Reserve's attempt to address a bigger risk on the horizon, and the ensuing flight to safety briefly dropped the 10-year below 1%. During the periods of uncertainty and fear, investors can sometimes be at a loss for what they should be doing. In this video, I'm going to offer 3 suggestions that every real estate investor should consider. First, investors need to review their assets and consider both their strategies and their downside risks. At this point, a recession is still improbable because the factors that drive economic growth, such as corporate profits, job creation, and consumption, all remain positive. However, the negative news cycle could deteriorate consumer and business leaders' confidence enough to drive spending cuts, and that could lead to an economic downturn. Through a portfolio evaluation, investors need to decide which assets they plan to keep and which should be pruned. If there is an asset to sell, it should be done quickly because the market right now is still very strong and there are a lot of prospective buyers at the table. After that, investors need to determine if they'll exchange the funds into a new acquisition or if they will take chips off the table and pay taxes. The second thing every investor should do is evaluate the loans on existing assets. Interest rates are at a record low, and this represents a unique opportunity. Investors are locking in loans with interest rates under 3% in some cases, so refinancing assets may boost yields on existing properties. The one hurdle investors need to pay attention to is whether they have prepayment penalties on their loans. Review the terms of your loans and make sure that you don't have a prepayment penalty, but even if there is a penalty, it still might make sense to refinance. And the third action investors need to consider is making a purchase. The extremely low cost of capital right now may deliver particularly strong levered yields. The spread between cap rates and interest rates is at its second highest level in 30 years, so it may be a good time to consider opportunistic acquisitions. In wrap-up, the financial market volatility sparked by the spread of the coronavirus can be disconcerting, and it is certainly raising fear levels. But real estate is a long-term investment with considerably less volatility than other investment options. Despite the barrage of scary headlines, it's important to make decisions based on the long-term economic and investment dynamics within the context of the current market conditions and return potential. And within that context, I can't think of many options with a stronger offering than real estate.